Welcome, everyone, to part one of Marcum's webinar series on the Tax Cut and Jobs Act. Today I'm going to go over a summary of the new tax provisions as they relate to corporate and pass-through entities. So the agenda, what we'll talk about is the new 20% pass-through deduction, which is now referred to as Section 199 Cap A of the Code. We'll talk about C corporations versus any other form of entity. We'll also discuss some other business provisions as they relate to partnership changes, tax accounting methods, conformity rules, little update on depreciation. This is a significant change that we'll get into business interest deduction, some retained tax credits, limitation on corporate and non-business losses, and then close out with some of the changes regarding meals and entertainment deductions, and then I'll address some planning opportunities as we head into 2018, which is really the year that most, if not all, of these changes will take place. So as we know, Trump campaigned on tax simplification, and his goal was really putting all businesses on an equal footing so that it really shouldn't matter what type of entity structure you were. And as you'll see shortly, that is really not entirely the case. So let's begin with the 20% pass-through deduction. Beginning in 2018, a deduction of 20% of what is now defined as qualified business income, QBI, from a partnership, S-corp, sole proprietorship will come into play. And when you run the rates and you compare the highest tax bracket now for the individual set at 37%, and if you were to apply the 20% deduction with no limitation, that would could bring the effective tax rate down to 29.6. And you'll see a little bit later when I compare and contrast tax rates, individuals versus corporate, you'll see this a little bit clearer. So what Section 199A now requires the taxpayer to do is to calculate their QBI from each separate trade or business. QBI does not include reasonable compensation paid to S shareholders or guaranteed payments paid to partners. These are key aspects, and you'll see the interplay of this part a little bit later. So in terms of paying compensation, we got to query whether the IRS now, in the past, they challenged unreasonable compensation. We'll see if reasonable compensation now for services rendered comes into play relative to prior years. There is an overall limitation regarding this pass-through deduction, and that deduction cannot exceed 20% of the excess of taxable income over the net capital gain. If QBI is less than zero, that loss is treated as a carryover from a qualified business and comes into play in the following year. The 20% pass-through deduction is subject to exemptions and limitations based upon income, wages, and qualifying property. So in essence, you need W-2 wages and qualified property unless your income is below a certain threshold. The deduction is available to qualified trades or businesses other than certain non-qualified trades or businesses unless the owner meets that income exception. So a qualified trade or business is defined as any trade or business other than what they refer to as a specified service trade or business, or other than the business of being an employee. And in order to get the definition of a specified service trade or business, we have to look to another section of the code, and that's 1202E3A. And this limits services in the fields of health, law. You'll see engineering and architecture. They must have quite the lobbyists because apparently last minute they got pulled out of this definition and seems to have gotten a much better result than others of the service trades or businesses. And then you continue with the accounting, actuarial, consulting, et cetera, and then added to that is a new aspect. Not only do you need to look to the employees, but you also need to look to the owner to determine whether or not it is a specified trade or business. A qualified business income, the basic rule. We look at QBI from the pass-through, and the deduction is not a deduction to determine adjusted gross income, nor is it an itemized deduction. And this pass-through 20% deduction is available whether or not a taxpayer itemizes or uses the standard deduction. The deductible amount with respect to a qualified trade or business, and this is where the mathematics come in, and you'll see that there really isn't so much for tax simplification. This is pretty tricky when you go through the mechanics. We have to look at a number of factors, and the qualified trade or business deduction is the lesser of 20% of the taxpayer's qualified business income with respect to the trade or business, or the greater of, and here's where we see W-2 wages come into play and investment in qualified property. So it's a greater of 50% of the taxpayer's allocable share of W-2 wages from that qualified trade or business, or the sum of, and this is where the real estate lobby group got this pulled in last minute before the final bill, but it's the sum of 25% of the taxpayer's allocable share of W-2 wages with respect, again, to the qualified trade or business, plus 2.5% of the taxpayer's allocable share of the unadjusted basis of property immediately after acquisition, and we get a new definition of qualified property. And I'm going to run through some examples a little bit later so you can see the mechanics of this 20% pass-through deduction. So W-2 wages allocable to the qualified business do not include amounts that are not relevant or not related to that qualified business. W-2 wages also do not include guaranteed payments to partners. W-2 wages do not include 1099 payments to independent contractors. And lastly, W-2 wages are allocated to the shareholders and partners in the same proportion as the original deduction. So you need to look at ownership of the entity to apportion these W-2 wages, because that shareholder, that partner, is going to need that information when they go to do their personal tax return to reflect this QBI aspect. You also need to account for the separate trades or businesses that may be inherent in that overall trade or business. So if part of your trade or business includes a specified service business, you're going to have to segregate that information. Let's get into the definition of qualified property. So qualified property, with respect to any qualified trade or business, is tangible property of the character which is subject to the allowance for depreciation. That property has to be held by and available for use in the qualified trade or business, measured as of the close of the taxable year, has to be used at any point during the taxable year for the production of qualified business income. And this is key. The depreciable period has not ended before the close of business. So now we're coming into 2018. We have new tax law. We have taxpayers that own already existing tangible property, and we have to revisit the depreciable period. So a provision in Section 199A sets the depreciable period as a period beginning with the date the property was first placed into service and then ending the later of the date that is 10 years after such date, or the last day of the full year of the applicable recovery period that would apply to the property. And for recoverable periods, we need to look at the depreciable lives under makers. So just by way of example, residential property maker's life is 27 and a half years, and commercial non-residential property is 39 years for real property. There is a threshold level of income for which certain taxpayers would be exempt from the W-2 test or the combination of wage and 2.5% of the qualifying property. And in addition, even a specified service, trade, or business limitation would not come into play. And this is where taxpayers have taxable income of less than $157,500 for single, or $315,000 for joint returns. And when I refer to single is also now includes head of household, anything other than a married filing joint. If taxable income is over the threshold, then a phase out of the benefit of this exemption will be applicable for those taxpayers. And the full phase out for single is $207,500 and $415 for married filing joint. These amounts are indexed for inflation. When we look at the W-2 qualified property limitation, if the qualified property limitation and W-2 limitation is less than 20% of the qualified business income, and the taxable income does not exceed the thresholds mentioned previously, then that limitation or the basic W-2 qualified property limitation does not apply, and that taxpayer would be allowed the reduction of the full 20% between the threshold amount and that upper range limit. So let's take a look at some examples. We look at example one. We have married filing joint with taxable income of $300,000. Husband has qualified business income of $250,000, and the allocable share reported on the K-1 to the taxpayer for the W-2 wages from the qualified trade or business is $110,000. There is no qualified property. So when we go through the mechanics, first off, we look at 20% of the qualified business income. That would give you a result of $50,000, or 50% of the allocable wages would give you a limitation of $55,000. So it's the lesser of, and in this case, the deduction would be $50,000. If we take a look at example two, which will use pretty much the same fact pattern as example one, but will lower the allocable wages to $75,000. Since the taxable income of the taxpayer does not exceed the threshold amount, $315 for married filing joint, the W-2 qualified property limitation of $37,500, which is 50% of the $75,000 wage limitation, does not come into play, and therefore the full 20% deduction would be the $50,000. So this is a case where the taxpayer is below the threshold amount, and example two would actually be applicable even if that taxpayer was in a trade or business that is listed and described as a specified trade or business. So some of your law firms, association of medical practices, et cetera, if they're set up in a manner that there's a fair number of shareholders or partners, we may see some of the allocations to each individual shareholder or partner. They, again, tested at their own specific level, and the thresholds may or may not be applicable. So that's important to note, that even if you're a specified business, it doesn't mean that you're out of the box entirely. Let's take a look at example 3. And here what we've done is we've really increased the numbers significantly from example 1 and 2. So if we have an S corporation with one single shareholder, there's $3.5 million of qualified income after paying wages to the shareholder of $500,000 and $1,250,000 to the company's other employees. In addition, this S corp invested in machinery and equipment with an unadjusted basis immediately after acquisition of $10 million. So to go through the mechanics of the 199A deduction, first off, we have to compute the 20% deduction, which would be the $3.5 million times 20%, $700,000, and then we have to compute each wage limitation. So the first wage limitation would be 50% of the $500,000 plus the $1,250,000. Total wages would be $1,750,000. 50% of that would be $875,000. And then the second wage limitation would be 2.5% of the $1,750,000 plus 2.5% of the $10 million in equipment acquired. So if we look at that and combine the two numbers, we get $687,500, which is really the $437,500 of wage limit at 25% plus 2.5% of the $10 million is the total $687,500. And we compare those numbers, and we look at the greater of is $875,000. But since that is greater than the lesser of the two wage limitations, $875,000 is the greater of the two wage limitations, so we have to look at and test to determine which of these thresholds we get. And the conclusion here would be the deduction that taxpayer would be entitled to would be limited to the $700,000. So that was a lot go through on the pass-through entities. I'll reintroduce this when we compare and contrast the possible benefit of a C corporation versus a flow-through or pass-through entities. And really what we're faced with is all businesses will really need to evaluate their organizational structures and consider, facts and circumstances just beyond the current taxable income, the current tax rates, and the current environment. You really have to look at today and as well as down the road. So one of the important questions coming out of the tax bill is it better to conduct business operations now in a C Corp, or should we stay the course and remain a pass-through entity, a sole proprietorship, a partnership, LLC, S Corp? And again, there really is no correct answer. We really have to look at all circumstances and consider a number of factors before making this final decision. And I'll point out some of the factors that I think are important in this overall analysis. But what raises this question is, let's take a look at the corporate tax rates. Today, 2017 year has just ended. We'll be filing returns. Companies will be paying taxes under the pre-act law. And if we look at the pre-act law, we saw that corporate rates started at 15%, and depending upon the level of income grew to a rate of 35%. And in addition, the corporations had the alternative minimum tax at a flat 20% rate. Post-2017, the Tax Cut and Job Act introduces a flat 21% corporate rate. In addition, the corporate AMT is repealed. So that's a significant rate reduction, and just at the surface level, it kind of implies that operating as a C Corp could be a beneficial entity structure for tax purposes. As I mentioned, the AMT eliminated for C Corps. There is a provision that if there are minimum tax credit carry forwards, there's the ability to have those credits that are not being utilized to offset regular tax. There is a refund provision within the new tax bill. Just to point out, because this comes into play with our later analysis of the C Corp versus the pass-through entities, there was a little bit of easing on the AMT for individuals. And what you see here is that the exemption amounts were increased for both the married filing joint as well as the single taxpayer. The exemptions and phase-outs are indexed for inflation. So let's continue with our discussion regarding the myth of the rise of the C Corps. So what we see now in 2018, the highest corporate rate of 21% will be actually 16 percentage points lower than the highest individual rate of 37%. This suggests a significant tax savings for businesses which operate in the C Corp status. Additionally, since corporations can fully deduct state income taxes and individuals are limited, as well as limited by the way of pass-through entities because the taxes are paid at the partner or shareholder level, this benefit to being a C Corp would appear even larger. However, you really need to assess the specific facts and circumstances of your own unique situation. Three factors counter this seemingly overwhelming advantage of a C Corp and the potential 16% lower rate. We have to take a look at the new individual rates and the new brackets. We have to factor in that deduction for the pass-through entities, which I went over under Section 199A. And we also, and this is a big detriment or hurdle to doing business in the C Corp form, is the concept of double taxation. When taxes are paid and funds are later withdrawn or distributed from the C Corp to the individual shareholders. So when we look at the tax comparison of business entities, more often than not, we tend to focus on the highest tax rates. But it is fair to say that not all businesses will allocate to its owners business income of $600 or more for the joint filer or $500 for the single and head of household. These are the levels at which the 37% rate applies. So consequently, depending upon the income of the pass-through, depending upon the number of partners or shareholders, frequently we'll see that the partners or shareholders could be subject to the lower individual rates, which now range from 10 to 35%. And what's key with the Tax Cut and Job Act when it comes to the individual rates is these new lower brackets don't have a phase-out mechanism. So all taxpayers will get the full benefit of those lower rates. As we previously discussed, the Tax Cut and Jobs Act introduces the deduction for pass-through entities equal to 20% of the qualified business. And really what this does at the exemption amount, it lowers the effective tax rate to that individual shareholder or partner as it relates to the pass-through income. And it gets that rate closer to that 21% corporate rate. And if we look at the next slide and consider the second shareholder level of tax when that C Corp distributes profits as a dividend, or there's a capital gain produced on the sale of the shares at a later date down the road, we do have qualified dividends, which are taxed at a lower rate. We do have long-term capital gains that are also taxed at a lower rate. But we do have the carryover of the net investment income tax, which was put into place and more often than not commonly referred to as the Obamacare tax. And if we just compare in the three columns, if we look at the stated individual rates and we progress up to that highest rate of 37%, and if we were simply to factor in a 20% reduction on the pass-through in the middle column, and the last column compares paying corporate, being organized as a corporation subject to C corporation taxes, and then looking and factoring in that 20% capital gains rate or qualified dividend rate on the payout or the distribution of profits as a qualified dividend. The higher 20% rate kicks in at 24% or higher bracket for the individual. And if we blend that all in, if you look at the fully loaded double tax on the C Corp relative to the pass-through rate, relative to the highest individual rate, you'll see the double tax situation really creates a rate that is greater than both the highest individual rate of 37% and the net effective rate considering the 20% pass-through of 29.6%. Now, obviously, in all scenarios, specific facts and circumstances need to be addressed. For the most part, one of the big items with the C Corps is what is the timing on that retained earnings? When will qualified distribution dividends be paid? When will that entity be sold? Will we be able to get a sale of the stock versus sale of assets to really do a full analysis of entity organization and structure for tax purposes? This analysis does get a little bit skewed for businesses which cannot utilize the new pass-through deduction. And when you get to those higher brackets, 35 and 37%, you see how much closer it gets to the double taxation inherent in the C corporation. Now, the C corp rate would come down just a little bit when the deduction for estate taxes are considered, but I have not factored this into the analysis. So based upon that summary and look at the relative comparative rates, some would immediately suggest that operating in the C Corp and retaining the net after-tax proceeds in the business could be more beneficial. We would look at the future growth being taxed at 21%, which could be lower than the tax rate of the owners, but the C Corp, we must still consider and take into account the concept of an accumulated earnings tax, which is really a backdoor tax which prevents certain corporations from retaining funds beyond its reasonable business needs. For the most part, a corporation is allowed to accumulate up to $250,000 of retained income, really without any question. But once the company gets beyond that level, it really needs to be in a position to demonstrate to the IRS that the amounts retained above this are for the reasonable business needs of the company. Reasonable business needs could be easily argued for some businesses, but gets a little bit more difficult for some of the companies that are operating as primarily service businesses where working capital needs, bank covenants, bonding, surety purposes may not come into play. But when you look at perhaps contractors or manufacturers that have real tight, strict bank covenants arguing for retention of earnings and accumulations over the $250,000 becomes a little bit easier to substantiate that for purposes of IRS audits and inquiries. Like I mentioned, the service businesses may have a problem demonstrating the need to retain funds and could be forced to distribute money to their shareholders. In addition to the tax aspects, we really need to take a look at the non-tax considerations regarding entity structure. And here I've listed out just some of the things that should be considered. I talked about working capital, talked about debt requirements, covenants, but also we need to take a look at ownership structure. Certain corporations, certain pass-throughs are limited. For example, S-corps can only have one class of stock. There are eligible shareholders that can't own S-corp stock. We got to look at transferability of interest issues. Partnerships allow significant flexibility when it comes to priority returns, waterfalls, allocation of losses, and take a look at, are we going to be able to sell this business by selling the stock interest? Most buyers, as we know, don't want to buy the stock of a company. They want to buy the assets of a company, so we have to take a look at that. In addition, compensation factors, fringe benefits, mergers and acquisition, corporate format accommodates those acquisition methods relatively easily in most cases, where other types of structures really don't. So a lot of factors that come into play other than just looking at the straightforward income tax aspect. In terms of the sale of the business, we talked about if a stock can be sold, that's great. You'll be ahead of the game. But when assets are sold, most of the flow-through entities look through the assets held to determine whether you have ordinary income or capital gain or loss. If those assets or stock are held more than a year, you're looking at a lower preferred rate. And then the reorganizational structures in the corporate arena, mergers or acquisitions can be set up in a stock-for-stock approach, which could defer taxes or the recognition of gain to an event down the road. As I mentioned, in regards to a buyer wanting an asset acquisition, they want to be able to step up the basis in the assets that are acquired and be able to reset the clock and start depreciation over and above. So where a corporation recognizes gain and pays tax at a 21%, we really need to look at a corporate sale of assets followed by liquidating distribution to the shareholders, and then we get back to that earlier chart which compares the double taxation. And more often than not, we're looking at overall taxes from the sale of assets in a C Corp arena versus a pass-through, even if they qualify for long-term capital gain treatment, that fully loaded double tax corporate rate may end up being higher. What also needs to really be factored in is, what is the timing? If you look at the present value of the tax potential for tax savings, that could outweigh that double tax down the road. So there's a number of factors which really need to be considered in the overall analysis. When we compare and contrast to a C Corp, we do have to factor in the number of shareholders, partners, as I mentioned earlier. If you're spreading that qualified business income to a fair number of partners or shareholders, perhaps everybody's not going to be taxed at the highest rate, and perhaps some of the shareholders or partners may get the full benefit of that 20% pass-through deduction. In regards to some of the changes that relate to partnerships, we do have a change in a technical termination rule. Previously, a partnership was deemed to end if there was a sale of 50% or more of the capital or profits interest. That no longer applies. In regards to carried interest, after 2017, there would be long-term capital gain treatment for carried interest if that interest is held for a period of 3 years or more. Any interest held for less than 3 years would be treated as a short-term capital gain. Some rules as it relates to tax accounting changes and accounting methods, very favorable. In the past, C corporations, you could only be on the cash method if you had $5 million or less in average gross receipts. That's now stepped up to $25 million. Cash basis taxpayers under Rev Proc 2002-28, the average gross receipts needed to be $10 million or less. That is now raised to $25 million. So very favorable opportunity to revisit cash method of accounting. Manufacturers subject to the uniform capitalization rules on building inventory. Now we're looking at a $25 million threshold. And very favorable for the small contractors is the $10 million average gross receipts test for the ability to use the completed contract method is now stepped up to $25 million. The tax bill does introduce this conformity concept, and where a taxpayer has an applicable financial statement, which is typically financial statement that is an audited financial statement in accordance with generally accepted accounting principles or pursuant to SEC filing requirements, if there are book tax differences, this conformity rule, just in a simple approach, states that income must be recorded for tax purposes no later than when it's included in this applicable financial statement. There are, however, carve-outs for cash basis rules, which I went over before, as well as percentage of completion methods of accounting, small taxpayer exemptions under 460 of the Internal Revenue Code. Some items as they relate to depreciation. We do have 100% bonus depreciation continuing for assets acquired after September 27, 2017, up through 12/31/2022. We get 100% depreciation. Then we see a phase-out beginning in 2023. So a company that acquires property post-September 27, you could essentially write off the entire cost of that qualifying property. And now included in qualified property is it's applicable both to new property as well as the acquisition of new property. When you're not able to use bonus depreciation, there is a provision retained which we refer to as Section 179 expensing, and there we can get a $1 million deduction for the immediate acquisition of property. That $1 million is phased out where the acquisitions exceed $3.5 million. They brought in the definition. You'll see energy, heating, and air conditioning property qualifies. Qualified property now includes improvements, roofs, HVAC, fire alarms, security systems. Real estate depreciation is retained at the 27 and 39 years. This ADS period, just keep that in the back of your mind when I get into the business interest, deduction, limitation, and you'll see the applicability. Listed autos, they bumped up the first year depreciation. Now another mechanical formula that needs to be addressed on an annual basis, and this is where businesses now may be subject to a limitation on the deduction of interest. And when we look at the deduction of interest, we take into account and measure the income before certain deductions. If your business has average annual gross receipts of $25 million or less, you could be exempt. However, when you measure this, you have to take into account interest that may be commonly owned, affiliated service corps. So if you are and you meet that requirement, then you're not going to be subject to this limitation. Any company that's over the $25 million is going to be subject to this interest limitation. Any unused interest expense in the current year gets carried forward, and then certain real property trades or business can make an election not to be subject to the interest deduction limitation, but in consideration of making this irrevocable election, they need to depreciate their real estate over the longer ADS period, which for non-residential becomes 40 years instead of 39, not a big difference. 27 and a half year becomes 30, and 15-year property becomes 20. The DPAD deduction, domestic production activities deductions for contractors and manufacturers, is gone, and this is a big change too. Like-kind exchange now will only apply to real property that is exchanged for other real property. Personal property trade-in of equipment is no longer, you can no longer use the like-kind exchange gain deferral. Some of the retained credits, tax credits, are listed out for you. Business credits, where you have projects that were eligible for the certified historic credit, those will continue. However, the rehab credit for any pre-1936 property is repealed. Another loss limitation is the NOL limitation. The 2-year carryback for losses incurred after December 31, 17 is repealed. You can still carry back losses arising in 17, and then going forward, losses for tax years beginning after December, the loss is carried forward indefinitely, but the limitation or the deduction is going to be limited to 80% of the taxable income, which is not too different than what the AMT rules had, where it limited that NOL carry forward. So businesses will now have to track their NOLs by year because different limitations may apply. Non-corporate taxpayers. There is a limitation on the losses to the extent that there is excess business deductions over income. A taxpayer can take a deduction of up to $500,000, married filing joint, $250,000 for other taxpayers. Any disallowed loss is considered a carry forward, but its character changes to a net operating loss. And this limitation is applied at the partner or shareholder level, and it's taken into account after applying the passive activity loss rules. Meals and entertainment, some new limitations. So if you've already paid for your Super Bowl tickets in 2018, if you bought them in advance in 17, you're okay, but 2018, those are 100% non-deductible. So recreation, sporting events, activities really need to separate these going forward because the cost of entertainment has now gotten way more expensive. Fringe benefits for employees, some of these now become disallowed in terms of qualified transportation, fringe benefits, parking, mass transit, and then even where meals were supplied to employees, even at an eating facility at the business, those are now subject to the 50% disallowance. So that's some highlights of the business aspects coming out of the Tax Cut and Jobs Act, and really in regards to planning opportunities, just some suggested steps and focal points going forward. Really work with your Marcum partner to project the impact of the Tax Cut and Jobs Act. And a good way to do that is take a look at 2017 and roll it forward. What would be different if all of these limitations and changes in the rates are implemented based off the data from 17, and try to get an overall picture so you can plan now to make and consider whatever appropriate changes need to be addressed to try to reduce the overall bite. Certainly in terms of tax simplification, I think I've showed you enough that it really isn't so simple. We have to consider a lot of facts and circumstances over and above taxable rates, considering whether to convert to a C Corp. Sole proprietors may want to look at reorganization if their qualified business income is going to be above the threshold amounts, because those W-2 wage limitations kick in, and a mechanism to trigger wages should strongly be reviewed. Talked about reviewing entity structure. You may want to take a look at your partnerships. Guaranteed payments are going to be an issue. Reasonable comp is going to be an issue. And then tax methods of accounting should be looked at. Elections could be made to take advantage of these new thresholds. Cost segregation studies still come into play with real property acquisitions, focusing on maximizing front-loading the depreciation. So as I said, this is tax simplification. And I understand that your 2018 postcards to submit your tax returns are now currently under design as we speak. So that's my presentation as it relates to the business and flow-through entities. Certainly open up for questions at this time. Our first question, does the Section 199A pass-through deduction include individuals with real property? Yes, it does. And if you recall, you'll see the computation that comes into play when you do have an investment in real property, so you have to go through those mechanics. Will loss from one company offset income from another company? Generally speaking, yes, provided you get through the separate basis calculations and your ability to take that loss. And are all companies accumulated to compare to taxable income? I'm not sure that I follow that. I'll take that to read that you do consider all of the income from flow-through entities coming through your returns. You do have to perform the W-2 test and wage limitation, as well as the overall limitation on the QBI. Next question, do passive loss rules factor in? Yes, there's really no change in the passive loss rules. That continues to be measured on the same basis pre-change in the law. Next question, does bonus depreciation of 179 election affect capital total? The measurement for the 199 deduction looks at the cost, the acquisition cost of property. So other than the exemption out in certain cases where the lives get longer, you're looking at the acquisition cost, the gross cost, not factoring into accumulated, not taking into account accumulated depreciation. Guaranteed payments, there was a question on that, and we certainly need to reconsider and look at partnerships, how income is allocated, and see if there's a way to get the partners the same level of income but put them in a better position for purposes of being able to qualify for the pass-through deduction. Another question is, if I have a C Corp that has an increasing stockholder loan, would you recommend giving the current changes starting to characterize that loan as dividends? Well, we'd really have to take a look at how that loan came about and what the corporate structure looks like, because if it is a loan receivable, paying that out as dividends under IRS audit, if nothing has happened on that loan, you have exposure that the entire loan could be a dividend in full. So you'd have to revisit that loan term. Hopefully it's papered. Hopefully interest is being paid on it now. If you pay, if you pay state taxes twice in the C Corp and once in the pass-through, both corp and individual, I'm going to interpret that question to be maybe not what it was intended, but certainly a C Corp could deduct the corporate taxes. An individual on receipt of that dividend from the C Corp would incur state taxes. However, if their cumulative property tax and income tax is over $10,000, they may not see the benefit of that deduction. There was a question in regards to understanding the limits based upon wages. The wages are the total allocable wages for all employees, and that would include the W-2 wages paid to the owners as well. So an S Corp with several employees as well as the owner certainly increases that wage base and increases that equation based upon the W-2 limits. If you've already elected S Corp status and you wish to change to a C Corp, can you re-elect S Corp? In certain circumstances, you can. You have to look at the aspects of post-election change in regards to any of the S Corp attributes as they carry over. There's rules related to future distributions. But again, based upon what we discussed, it may not be the overall best structure to be a C Corp. You have to consider a lot of other non-tax aspects, and I think a good analysis should include the present value of projected cash flow and a hypothetical sale down the road. Some additional questions. If I have two C Corps and partnerships with the same owners and their engineer and the S Corp is engineers paid wages, how does the $315,000 limitation apply? Well, what you have to do is, in that slide, you'll see you have to look at your qualified business income, and before you get to the qualified business income, you got to take a look at, is that pass-through entity eligible for the 20% deduction? If it is eligible, you move it into one bucket. If it's a non-eligible business, then it really never comes into play. And when you look at the W-2 wage limitation, you're looking at the deduction as it relates to each of the qualified business income pass-through entities. So I think that brings us to the end of today's webinar. I certainly apologize if we were not able to get to your individual questions, as there were certainly a number of questions. We do have a list of those questions, and we will do our best to follow up to the extent that we can. If any question does come up at a later date, you do have my contact information, and we'll be happy to assist you in any manner that we can. Thank you very much, everyone, for the opportunity to present to you today.